Hello everyone, and welcome back to the channel. Thank you so much for being here today. If you haven't already, make sure you subscribe, hit that like button, and turn on the notifications so you don't miss any of our deep dives into what's really going on behind the headlines. Because today, we're going to tackle one of the biggest mysteries in modern economics, one that confuses millions of people around the world. If the economy is doing so poorly, if businesses are cutting jobs, if inflation is squeezing families, and if people are struggling to pay rent and afford groceries, then why is the stock market hitting record highs? It's a fair question, one I see all the time in the comments and on social media. For decades, people believed that the stock market was a mirror of the economy, that when stocks were strong, the nation was strong. But that mirror is now shattered. Because what we're looking at today isn't a reflection of real strength. It's a distortion, a mirage created by decades of cheap money, speculative mania, and the manipulation of financial systems that no longer resemble the world you and I live in. Let's start with the numbers, because they tell the story better than anything else. In August of this year, Nvidia, a single American chip manufacturer, reached a market capitalization of $4.4 trillion. Just to put that into perspective, that's more than the entire GDP of Japan. It's larger than the economy of India. It's greater than the total market value of every company listed on the Swiss stock exchange combined. Think about that. One company that produces semiconductors, tiny pieces of silicon, is, on paper, worth more than entire nations. In fact, Nvidia's value now rivals the combined worth of all the farmland in the United States, and it represents nearly 1/5 of the value of every ounce of gold ever mined in human history. Does that sound normal to you? Because Nvidia doesn't grow food, it doesn't build homes, it doesn't pave roads, it makes chips. Yes, they're powerful and essential to modern technology. But do they justify a valuation that's larger than the economic output of Japan and India combined? Of course not. This is the absurdity of modern finance. A system where valuations soar into the stratosphere, detached from reality, powered not by productivity, but by perception. And Nvidia is not alone. The so-called Magnificent Seven, Apple, Microsoft, Amazon, Alphabet, Meta, Tesla, and Nvidia, now have a combined market capitalization of over $19 trillion. That's more than the GDP of Germany, Japan, and India combined. These numbers are so inflated they've lost meaning. The stock market no longer mirrors the real economy. It mirrors an artificial world created by monetary excess, financial engineering, and policy decisions designed to keep the illusion alive. So, how did we get here? To understand that, we need to rewind decades back. You could trace it to the collapse of the Bretton Woods system in the 1970s when currencies were decoupled from gold, freeing central banks to print money at will. But the real turning point, the true beginning of our modern financial distortion, came after the 2008 financial crisis. When the global economy was on the verge of collapse, central banks stepped in with extraordinary measures: quantitative easing, zero interest rates, government debt on an unimaginable scale. At first, these measures were sold as temporary, emergency fixes to stabilize markets, but temporary became permanent, and those policies didn't just rescue the economy, they reshaped it. They built an entirely new world order where money was no longer scarce, where risk was no longer punished, and where finance became detached from real life. Trillions of dollars were conjured into existence with a few keystrokes. Central banks flooded the system with liquidity, handing that new money first to private banks, hedge funds, and large corporations. And this part is crucial, because that's where the distortion began. Economists even have a name for it: the Cantillon Effect. When new money enters the economy, it benefits those who receive it first, the financial elite, because they get to spend it before prices rise. By the time that money trickles down to you and me, the average workers and consumers, prices have already gone up. So, the wealthy accumulate more assets, while the rest of society gets stuck with higher costs of living. Two kinds of inflation emerge: consumer inflation, which eats into wages and savings; asset inflation, which makes the rich even richer. For more than a decade, we've lived under artificially low interest rates, sometimes even negative. In Europe, banks were literally paying companies to borrow money. And what did those companies do with that cheap cash? Did they invest it in new products, in research, innovation, or worker salaries. No, they bought back their own shares. This financial engineering reduced the number of shares in circulation, driving up the price, making their balance sheets look stronger and executives richer, without actually creating anything of real value. And central banks celebrated. They called it market stability. They believed they'd fixed the system, but in reality, they were inflating the biggest asset bubble in history. Of course, some corporations, like Apple, do earn astronomical revenues. Apple made over $390 billion in 2024, more than the GDP of many countries, but those rare successes have been used to justify the absurdity of the rule. For every Apple, there are dozens of companies trading at 50 or even 100 times their earnings, valuations driven not by innovation or demand, but by speculation and hype. This disconnect between price and value is the central problem. Markets were once places of price discovery, where investors determined what something was worth based on fundamentals, on earnings, competition, and risk. Now markets have become casinos, with odds controlled by central banks. Everyone plays because there's no alternative. Even the professionals know the game is broken. In a recent Bank of America survey, 91% of fund managers, controlling nearly $500 billion, admitted U.S. equities are overvalued, and yet they stay invested. Why? Because they have no choice. In a world where cash yields nothing and speculation is rewarded, even the smartest players are trapped in the same bubble they helped create. But this story isn't just about markets or numbers. It's about asset inflation has quietly rewritten the rules of our world. The divide between those who own assets and those who don't has become the defining feature of the modern era. Owning a home, once the cornerstone of middle-class life, is now a distant dream for millions. Retirement savings can't keep up with distorted markets. Young people, drowning in debt and high costs, see wealth as something reserved for the few. This is more than financial inequality. As wealth concentrates in fewer hands, trust in institutions collapses. The middle class, the foundation of democratic stability, feels squeezed, ignored, and shut out of the future. Meanwhile, the elites live in a parallel universe where paper wealth grows endlessly, and the struggles of everyday people are invisible. We now live in a world where paper wealth grows faster than real wealth, where the numbers on stock screens rise while real wages stagnate, where the market celebrates record highs, even as families fall deeper into debt. The system has become self-reinforcing and dangerously fragile. All it would take is one shock, a sharp rate hike, a debt crisis, a geopolitical conflict, to trigger a cascade that wipes out trillions in paper value overnight. But the true danger isn't just the crash itself. It's what happens after. Because if people lose faith, not just in the market, but in money itself, then the legitimacy of the entire financial order could unravel. When that belief collapses, everything else follows. The story of asset inflation isn't simply an economic narrative, it's a moral one. It's the story of what happens when money loses meaning, when value no longer comes from productivity, but from manipulation, when markets reward speculation, not innovation. When finance forgets its original purpose, to allocate capital efficiently, to fund ideas, to build, to grow, to serve human progress. And unless we find a way to reconnect finance to reality, unless the system is recalibrated, the next collapse won't be just another market correction. It will be a reckoning, because no matter how high the stock market climbs, no matter how loud the celebrations get on Wall Street, the laws of economics and of human society always bring things back to earth. So, the next time you see headlines about record stock prices, ask yourself this: are we witnessing economic strength or just the final stage of a grand illusion? The answer might determine how this era is remembered, not as an age of prosperity, but as an age of deception. Thank you so much for watching. I'd love to hear your thoughts. What do you think happens when this bubble finally bursts? Let me know in the comments below. If you enjoyed this video, please like, subscribe, and share it with others. It really helps the channel and keeps this work going. Until next time, take care, stay informed, and never stop asking questions.